last year, James analyst at Scottish Mortgage said there was a chance that Nvidia could be worth $50 trillion in a decade.
Combining data center compute with compute on our phones, at the moment Nvidia has no real presence there, if at all. No matter how good the business is, if, pension funds reallocate, move money out of the US, all stocks will struggle. Buying certain stocks which have strong presences in their area could be a sort of quote-unquote lower risk way of gaining exposure to growth trends.
Hello, with me today I have Harry Evans, technology analyst at Singer Capital Markets. Hi Harry, nice to have you today.
Hi Lee, thanks for having me.
We're going to talk about tech stocks and not just the big American technology shares, the Magnificent Seven, but also other smaller companies caught up in theme-based rallies like AI and quantum computing. Now, lucky investors have made a lot of money in the sector over the past couple of years, but I guess the big question is, should they stay invested in tech, and are there still opportunities for others to buy?
Undoubtedly, the market or the technology shares have done very well, particularly the Magnificent Seven that you mentioned, but less so really UK stocks. In the UK, there have been some technical reasons, so let's say withdrawals from a sort of pension perspective, which has actually left very good UK companies undervalued and actually overlooked, in my opinion. The big Magnificent Seven, I would 100% advocate an allocation to them because you wouldn't want to miss necessarily the prospects that they can deliver. But I would also highlight UK stocks as being, particularly on a relative basis, undervalued and overlooked. And I think that that's where there's greatest value, in my opinion, right now.
Right, well, I mean, tech stocks have raced higher following the April crash. So it doesn't feel like we can really talk about bargains anymore. Pessimists are always going to focus on valuations as well. How do you answer the criticism that tech stocks are overvalued?
One always has to remember, or at least I try to, that it's valuation relative to risk and growth, and I think it's important to remember the valuation in that context. And I would actually argue that the tech sector is growing higher relative to what, let's say, the sort of UK GDP or US GDP, and also because of the nature of the businesses and annual recurring SaaS businesses, which has sort of become prevalent in that they've got a lower risk. So the quality of those businesses is higher. So I think I would just caveat that in that technology stocks are always going to trade higher, typically because of their qualities and of the opportunities that they have. Some, let's say Palantir, it's hard to argue, it's probably on 50 times revenue. It's hard to argue that that would be undervalued right now. While the tech sector as a whole is fully valued because of certain names have done particularly well, undoubtedly there's high levels or good levels of value opportunities within that, particularly within the UK.
So we've heard some quite incredible predictions about tech prospects. Last year, James analyst at Scottish Mortgage said there was a chance that Nvidia could be worth $50 trillion in a decade. So it's currently worth just under 4. So what do you think about this and some of the other wild claims made about tech sector potential?
It's difficult to comment specifically on that claim, and he's probably run the maths better than I have. So for Nvidia, it's pivoted very successfully from a Bitcoin to a gaming to a AI company, but its traction and its growth to date has really been within the data center. What we're finding now is more computing is turning to the edge. So if we think about, let's say, Apple Intelligence, that is now combining data center compute with compute on our phones. At the moment, Nvidia has no real presence there, if at all. Apple currently provide their own GPU chip. But mobile phone, the market, we know it's in its billions. Maybe this gentleman had similar such hopes in terms of how he thought Nvidia could approach that. But that would be definitely one way. So far, awareness of AI has, let's say, been ChatGPT and sort of the rise of LLMs. And what that has given us is basically the ability to ask obscure questions, nuanced questions, and provide a response. But the problem is it's been basically in request and response. It's basically been, in my view, a bit like Wikipedia, but way more advanced and way more sophisticated. Where there's the opportunity to accelerate that is then embedding AI within tasks to automate it. Some people call it basically AI workflows, and I would liken that effectively to sort of assisted driving. And then you could take that one step further and you can call it AI agents. And this is effectively fully automated tasks, improving productivity, which I just talked about. And we've actually seen very little traction of that to date. So far, Microsoft have obviously come out with their co-pilots, and that's more about the assisted driving analogy. Where I think there's huge amounts of productivity is where we can embed AI to interact with several applications so that humans are removed from that loop, improving productivity. And I see a huge amount of headroom, whether that's for the Magnificent Seven, for Microsoft and Google. There's a really interesting opportunity with smaller companies. At the moment, and as you might be aware, that AI and let's say ChatGPT, it's only can request or access information that's freely available and not behind a paywall. And so what AI has done is it's basically potentially increased the value of information, because how you can query that, the techniques and your ability to interrogate and extract information has really increased. Data businesses that potentially can enhance their value proposition by integrating AI. And examples of that, Windward, which a company that I covered, was a data business focused on the maritime industry, got acquired last year for about £200 million. Global Data, slightly different business, but was recently attracted a takeover bid earlier this year. Meanwhile, there's another business, let's say YouGov. We all know what YouGov does, but has probably been behind the curve in terms of how it's invested in AI. But I would argue with 30 million panelists, how actually it can provide value or insights to, let's say, the Unilevers of this world has gone up dramatically if it can leverage the sort of potential of AI. So I've gone on a bit of a ramble there, but I do think that there's lots of ways that companies, both large and small, can enhance their value proposition by embedding AI.
Look, how important is a lasting and substantial trade deal between the US and China? How are tech companies adjusting to this, the more protectionist and politically charged environment? I mean, it can be very inventive. Are boards making different decisions about location, supply chains and regulatory risk?
To clarify, at the moment, what's happened is that there is it's around hardware, and software and services are exempt, but hardware isn't. So for any hardware business that's importing, exporting between the US and China or any other country, it is, I would say, it's very high up on the agenda. What I've seen so far is that boards haven't wanted or been prepared yet to make the difficult decisions in that it's whether it's absorbing, so that will be absorbing the costs right now or passing it on. For what it's worth, in the US CPI most recently, actually there wasn't a lot of inflation, but whether that was effectively inventory. And so what my takeaway is that at the moment exporters are sucking up that margin rather than passing it on to US consumer. But undoubtedly, I think that there's going to be inflation, and I think that the GBP, the FX between, you've seen a weakening of the dollar against a basket, and that's clearly saying to me that there's going to be an inflationary environment, and there are going to be higher interest rates to compensate.
A lot of tech names are trading at or near record levels, and the impact of events like tariffs, geopolitics, conflict and other headwinds only ever seem temporary. Is there anything that can seriously derail the tech boom?
The market is always quite short-termist, so I think I would point to the logical short-term concerns in terms of risk. So either a reversal or an increase in tariffs that would harm. And I'd also say that probably because of the implications of AI, whether it's touching healthcare and education or various other industries, that there'll be multiple winners, not only in terms of individual stocks, but also in terms of sectors, and as a result, how growth may increase for the economy as a whole.
Turning to the UK, are there any listed tech names showing signs of encouraging growth? Any stocks that investors should be looking at right now?
So we touched on education. There's a company called RM Group, which has a software as a service education platform. It started out life in sort of formative testing. So that is effectively providing the back-end testing capabilities for people taking A-levels, GCSEs, and it's actually turned itself into an e-testing business, and it makes teaching or learning rather way more interactive. Enduring businesses, whether that's Alpha Financial or Cerillion, effectively they're the beating hearts of their respective customers, whether that's in the sort of auto leasing financing world or that's in the telco world for Cerillion. They are absolutely mission critical software solutions which have become best in class. Softcat and Bytes are brilliant reseller businesses, value-added resellers, really high return on capital, and they compound at about 10 to 15% a year, and I think they've got sort of single-digit market share. I think that they're good businesses. A smaller business, which I really think is interesting right now, is a company called Netcall. What Netcall does is basically intelligent automation software. And so Netcall acquired a company called Matsoft, a low-code provider. And this allows enterprises to develop the application that they want much more rapidly and at a lower cost. Unequivocally, the US is brilliant from a stock market perspective because it has market leaders. But one also inherits a lot of market risk. No matter how good the business is, if, pension funds reallocate, move money out of the US, all stocks will struggle, and there is a high amount of correlation. What I think is really good from a sort of UK perspective is not only is sort of they've been on the thin end of that wedge because of outflows, that they're under researched, and therefore the potential to sort of see something, whereas there's greater competition in the US from a financial market, and also there's less correlation from a stock perspective. So I think that combination, in that if you think, well, hang on a second, I really want to own Nvidia, fine, but I think one has to accept that there's sort of market risk associated with that. But there's more sort of less correlation from a UK perspective. So if one is more concerned about the short-term performance of their fund, I think sort of a weighting that includes both it is quite sensible. Or if you want to go even further, and we talked about AI and other ways to play that. There's ASML, which is a Dutch leading business, which is basically a provider. It sells to TSMC. TSMC is one of the world's largest foundries. So Nvidia doesn't make its own chips. TSMC will actually make those chips. So effectively, it's a way of playing the AI trend, as is ASML, which effectively is a supplier for TSMC. So if investors really want exposure to a supply chain by buying certain stocks which have strong presences in that area, could be a way of gaining exposure to growth trends.
Well, I was going to talk about diversification. So might those nervous about individual stock investing be better at looking at maybe a UK trust exposed to AI and the wider tech theme?
So several PE investors, as well as having their private equity funds, will also have an equivalent, a mirror image on it which is attainable via a UK trust, and that might be a way of attaining exposure to both private markets and public markets, both at a sort of a relatively low cost and a diversified way. HG Capital is one that springs to mind. It's a technology-focused PE firm. The majority of its assets are, private equity, but it does offer HG Capital Trust. I'm not sure the exact ticker, but it's listed on the London Stock Exchange.
we've talked about AI, and I've mentioned quantum computing. Are there any other broader sort of under the market or under the radar tech trends worth watching, and where else might growth or disruption be coming from?
Companies are going to be concerned about data sovereignty or data control. I think that there are going to be growth businesses, growth opportunities for services companies or sort of data governance companies around that. In the US, unequivocally, the mega cap names benefit from trends. Nvidia wouldn't be where it was had it not been for AI, and there are undoubtedly big trends. But on the flip side, when you're in the UK business, typically they're businesses which have got a materially smaller market share, and therefore the overall trend is lesser important. What's more important is that company's ability or potential to increase its market share. And that's what I quite like about, I touched on a company called Alpha Financial or Cerillion. Its end markets in both cases are actually growing only 3 to 5%. But why are they growing? It's because they've got a better mousetrap in that they've got a competitively superior product. We should, and I think it's fantastic to be aware of mega trends, but I would also say it's not the be-all and end-all, in that there are some brilliant businesses that have a competitive and potentially durable advantage, which could provide in turn strong returns for investors.
Okay, Harry Evans, technology analyst at Singer Capital Markets. Thanks ever so much for joining me today.
Cheers.